economics as a key determinant of business success. Cracking the code of economic forces behind business wins and wipeouts. Hi, I'm Jerry Skews, author of Business by Numbers and a business architect with over 40 years of experience in advanced analytical techniques. If business were a sport, the economic environment would be the playing field. It doesn't matter how good your strategy is, if the field is flooded, frozen, or on the tilt, you're going to have a tough game. That's the premise behind one of the most underrated yet critical insights from the book, Business by Numbers. The economy isn't just background noise. It's a fundamental determinant of business success. Put another way, the economic environment is like the weather for a farmer. You may have the best seeds, tools, and workers, but if you don't understand the climate you're growing in, then the harvest is going to be unpredictable at best and catastrophic at worst. So what exactly is the economic environment? And why does it matter to your business, startup, or investment strategy? Let's break it down. It's not just about GDP. It's about survival. The economic environment shapes everything, from whether your customers feel like spending to whether your bank will finance your next big idea. It impacts what you pay for materials, how easy it is to hire talent, how much interest you pay on loans, and how much investors are willing to back your vision. The economic heavy hitters in this space include interest rates, the heartbeat of borrowing costs; inflation, the silent tax on purchasing power; employment levels, a mirror of consumer confidence and buying strength; exchange rates, a game changer if you deal across borders; and consumer confidence, the vibe check of the economy. Capital is nervous, so you need to be smart. If you want capital, then get comfortable with economic trends. In uncertain times, investors get jumpy, banks get stingy, and fundraising becomes a game of wait and see. On the flip side, when the outlook is rosy, capital flows more freely and deals get done faster. Understanding the capital climate involves tracking economic growth, or the lack thereof. Understanding global interest rate trends, inflation volatility, regulatory shifts. Even emerging fintech tools are changing the very nature of how we raise money. The smart move is watching these signals like a hawk. Going global? Oh, right now the world is changing and will probably not revert to the laissez-faire economics we have all come to understand in recent years. For internationally minded businesses, the economic environment is not just about one country. It's dozens. Trade agreements, tariffs, supply chain bottlenecks, currency swings, and geopolitical instability all have a say in your bottom line. Want to hedge your bets? Diversify your supply chains, watch your currency exposure, and understand how global banking policies and cross-border taxes might impact your margins. Regulators, the unseen business partners. No one loves red tape, but ignoring regulations can be fatal. From tax codes and ESG mandates to anti-money laundering laws and fintech licensing, today's regulatory environment shapes the very feasibility of business. Staying ahead isn't just about compliance, it's about using regulation strategically. Think about lobbying for favorable policies or tax incentives, or leveraging your product for strong compliance positioning to give you a competitive advantage, things that others may well overlook. Technology is changing the game again, and it will continue to do so. The rise of fintech, AI-driven credit scoring, and alternative funding platforms is rewriting the rules of economic engagement. Now, startups can bypass traditional banking, SMEs can forecast better with predictive models, and global reach is possible with just a broadband connection. But there's a caveat. With tech innovation comes new risk, especially in cybersecurity and data privacy. Choose your tools wisely. Invest in your organizational knowledge. Measuring the madness, metrics that matter. Economic forecasting isn't fortune-telling, it's number crunching. Metrics like GDP growth, inflation, interest rate trends, money supply, and consumer confidence can help predict demand, guide pricing, and steer investment decisions. And yes, there are plenty of formulas for that. Economic growth influence, inflation sensitivity, interest rate forecasting, consumer confidence impact, even a market dependency ratio to show how exposed you are to specific regions. These metrics turn economic mood swings into actionable insights. The bottom line, here's the takeaway. The economy isn't something that just happens to your business. It's something you need to actively understand, respond to, and predict its trends where possible. By measuring the right economic indicators and understanding their implications, businesses can plan smarter, mitigate risks, unlock capital, find and seize opportunities, and stay one step ahead of the curve. So next time someone says, "It's the economy, stupid," take it as a compliment. It means you're paying attention to what really drives success, and you're ready to navigate whatever the global economy throws your way. There follows a 20-minute podcast that provides a deeper dive into the economic environment and how data can be used to give you an edge, no matter what your business is or its stage of development.
Welcome to the Deep Dive. Today we're trying to cut through all that economic data noise, really turn it into clear, actionable insights, just for you. There's this great analogy from Jerry Skews in his book, Business by Numbers. He says the economic environment for a business, well, it's just like the weather for a farmer. Doesn't matter how skilled you are, how perfectly you plant. Your success, your harvest, it's massively shaped by, sunshine, rain, storms. It's this huge force, often uncontrollable, right?
Mm-hmm.
Dictates so much.
That analogy really hits home, actually, because the economic environment, it genuinely forms the essential backdrop. It's where all business activity happens. It shapes your opportunities, influences risks, and ultimately determines if your strategies are even viable. Understanding these forces isn't just academic, it's absolutely essential for adapting quickly, for managing risks before they blow up, and, for grabbing opportunities when they pop up.
Okay, so our mission here in this deep dive is to unpack the really essential analytical approaches, the methodologies. For doing these economic impact assessments, we're focusing on what matters most for you so you can be well-informed, ready to navigate. Okay, let's get into it. All right, so to get a handle on these huge economic forces, we can sort of group the factors into two main buckets. You've got the big, broad, global economic factors, and then the more specific business-specific factors gives us a clear framework to start.
Exactly. And within that, one of the most critical pieces is economic volatility. I mean, think about it. Periods of high volatility. You see unstable interest rates, inflation jumping around, crazy market swings, maybe geopolitical uncertainty. All that stuff severely restricts access to capital. It makes borrowing more expensive, and investors, they get really, really cautious. It's like navigating a storm, like you said. But when things are stable, capital flows much more freely. Funding's easier to get, cheaper too. The key things feeding into this volatility are stuff like interest rates, inflation, economic growth, capital markets, also monetary policy, exchange rates, regulations, tax rules, and of course that tricky one, investor sentiment.
And talking about volatility, maybe nowhere is it clearer than on the global stage, right?
Yeah.
Our world is just so connected now. Even events happening far away can send ripples right through our supply chains, disrupting markets everywhere.
Oh, absolutely. When we talk global factors, we're looking at things like international capital flows, cross-border investment, lending. Then there's global interest rate trends. A rate change by the Fed or the ECB, that can hit borrowing costs worldwide. Big time. Supply chain integration. That means your business is exposed to costs overseas. And managing disruptions, that takes capital. And we can't forget trade agreements and tariffs. They directly shape who you can sell to, your market access, and they definitely influence revenue forecasts. Currency exchange volatility, that can mess with your international pricing, the value of your capital, and really importantly, geopolitical risk and stability. We've seen it, haven't we? Conflicts, sanctions. They can just freeze capital, stop it dead, makes it impossible for businesses to move funds, even if they're not directly involved.
Okay, so beyond the global picture, we also need to think about the immediate regulatory impact. Feels like government policies, regulations. They can bring pretty significant compliance costs, operational hurdles for businesses, often hitting their capital directly.
Indeed, they can. Regulatory factors can really change how easily you get capital. Take financial compliance, like Basel III, those international banking rules. They aim to strengthen banks, but they can raise costs or limit funding, especially for smaller firms. Licensing and operational approvals, they can cause delays, meaning you need more working capital just to bridge the gap. Securities and fundraising regulations literally dictate how and where you can raise money. Tax policy and incentives, they can either boost your capital efficiency or, if they're too heavy, just scare off investment. Even things like ESG, environmental, social governance rules, or anti-money laundering, AML, and know your customer KYC compliance. These are now crucial just to maintain access to banks and capital markets. Basically, yeah, every regulation seems to have a capital angle.
And finally, let's not forget that huge undeniable force, technological impact. I mean, the speed of innovation today, it's truly transforming economic conditions, and that includes getting access to capital.
It absolutely is. Technology is fundamentally changing how businesses get and manage capital. We see it with the rise of fintech and alternative funding, things like crowdfunding, peer-to-peer lending, new options beyond the old banks. Digital financial infrastructure, blockchain, real-time payments that stuff improve transparency, speeds things up, data-driven credit assessment, using AI, machine learning. Lenders can assess risk in new ways, might open up funding for businesses that were overlooked before. Automation helps cut costs in compliance, reporting, makes managing capital cheaper. Cybersecurity is now massive for investor confidence, and digital channels mean you can reach funders globally, massively increases your potential pool. But there's a flip side, disruption risk. Businesses that don't adapt, they can look riskier, find it harder, and more expensive to get capital.
Okay, let's shift gears a bit. Focus on econometrics, those wider economic factors that specifically hit market demand. For you as a business leader, getting a handle on government monetary and fiscal policy here seems absolutely essential for anticipating shifts in, consumer behavior, business investment.
It truly is, yeah. When we're monitoring government policy for market demand impact, several key metrics really jump out. First, interest rates. Specifically, the central bank rate. It's the headline cost of borrowing. Directly affects consumer spending, business investment, how much credit is available overall, big impact. Then, inflation rate. Usually measured by CPI for consumers, PPI for businesses. Rising inflation eats away at purchasing power. It can dramatically shift demand, right? Make some things unaffordable, change what people prioritize. Tracking the money supply, M1, M2, those measures of cash and liquid assets floating around, tells you about the economy's liquidity. So, for example, if M2 grows significantly, say 6% in a quarter, that signals more consumer liquidity. Potential demand increase. More money chasing goods. We also watch the fiscal deficit or surplus and overall government spending. These directly inject demand into the economy or pull it out. Taxation levels and policy changes directly hit disposable income for people and profitability for businesses. The unemployment rate. That's a key sign of labor market health. Consumer confidence, lower unemployment. Usually means stronger demand, more people earning. And finally, the Consumer Confidence Index, CCI. This measures how the public feels about the future economy. Hugely important for predicting spending trends, guiding your business planning.
Right, and the CCI is usually benchmarked at 100. So above 100 is optimism, below is pessimism. How's that actually worked out, and what does it really tell us?
Well, the basic idea for the CCI is pretty straightforward. It's essentially 100 times number of positive responses divided by total responses. So say a business does an internal survey. Get 60% positive responses, 25% neutral, 15% negative. Using that simple formula, your CCI is 60. That's a clear sign of pessimism in that group. So what's that mean for you? It's a forward-looking thing. It directly influences your market demand. Guides your strategy. If confidence is low, you'd expect people to tighten their belts. So maybe you adjust inventory, change your marketing. It's a crucial pulse check on your future customers.
Okay, now let's get into some of the really powerful formulas, the ones that help us quantify these impacts. This is where we really start to drill down, right? Moving from concepts to actual measurements.
Let's kick off with economic growth, often measured by GDP, gross domestic product. The growth rate is just the percentage change period over period. Simple enough. Example, country's GDP goes from 2 trillion to 2.12 trillion. That's 5% growth. Okay. For your business, though, the Economic Growth Influence Score, EGIS, is useful. It helps you see how sensitive your revenue is to that broad growth. It's basically the slice of your revenue change you can chalk up to GDP growth. So if your EGIS is high and GDP growth is forecast to slow down, you might want to pivot. Maybe less expansion, more focus on cash reserves, core services. But if GDP is picking up, a high EGIS says it's go time. Ramp up capacity, maybe look at new markets. Next up, inflation. That's the erosion of purchasing power. Its change is usually tracked using the Consumer Price Index, the CPI. Think of it as the speed limit for price rises generally. When it goes up, your money buys less. For forecasting it, well, there are sophisticated models like ARIMA, that's a statistical model for time series stuff. It looks at past inflation to predict future trends. An ARIMA model might, say, forecast a 3.38% inflation rate. Okay. For your business, the Inflation Sensitivity Index, ISI, is key. This tells you how much your costs go up because of inflation relative to your total costs. Tracking your ISI means you can be proactive, renegotiate with suppliers, look for alternative materials, maybe adjust your pricing to protect margins, better than just reacting after costs have already jumped. Right, employment. We often use something called Okun's Law here. It helps forecast employment levels based on GDP growth and unemployment rates. Basically, it links changes in unemployment to GDP growth. So let's say employment was 50 million, you get 3% GDP growth, and unemployment drops from 5% to 4.5%. Okun's Law might predict employment hitting, say, 52.125 million workers. That's a significant jump, shows a healthier job market. Then the employment impact factor links this back to your business. It shows how overall employment changes and therefore consumer spending power affect your revenue. If employment's rising, that's usually a strong signal for more demand for whatever you sell. Okay, interest rates. The cost of borrowing money, essentially. The Taylor rule is a common guideline central banks might use. It suggests an optimal interest rate based on inflation and economic output. A calculation using the Taylor rule might point to, say, an 8% nominal interest rate. That would suggest policy should tighten up to control inflation. How does this hit your business? Well, if actual rates are lower than the rule suggests, borrowing is cheaper, demand usually picks up, investment gets stimulated. If rates are higher, investment tends to slow down. Costs more to borrow. To measure your sensitivity, there's the Interest Rate Sensitivity Index. It tells you how much your interest payments change compared to your total operating costs. This helps you optimize your capital structure, maybe balance fixed versus variable rate debt, for example. And for your overall cost of capital, we use the weighted average cost of capital, or WACC. Think of WACC as the blended cost of all the money your business uses from shareholders, that's equity, and from lenders, that's debt. It even factors in the tax savings from debt. A typical WACC calculation might give you, say, 7.68%. The key insight for you: lower WACC means cheaper capital, makes new projects look better, less risky. Then there's interest rate volatility. How much do rates jump around? We measure this using standard deviation of past rates. To make it more real, think of a stability score. A stable market like Germany might have low volatility, maybe a score of 0.86, high stability. But a volatile emerging market, maybe Argentina, with big rate swings, could score only 0.25. That shows really unpredictable, risky borrowing conditions. Finally, credit spread. This one's simple. It's just the difference in yield between a corporate bond and a similar government bond, which is seen as risk-free. So say a corporate bond yields 6.5% and the government bond yields 4.0%. The credit spread is 2.5%. Easy. What does it tell you? If the spread widens, it signals the market sees more risk. Costs more for businesses to borrow. If it narrows, suggests confidence is up, capital is easier to access. It's a quick market pulse check on corporate borrowing risk.
Okay, let's shift our view outward now. How do global dynamics, specifically international trade exposure and risk, play a role? Especially for businesses operating across borders, right?
Yeah, definitely crucial there. We can look at the exchange rate exposure risk, ERTR. This basically measures what chunk of your foreign revenue or costs, once you convert it to your home currency, makes up your total revenue or costs. Here's a strong example. Imagine a company gets a quarter of its total revenue from foreign sales. That means 25% of their revenue is directly exposed to currency swings. That can seriously impact their bottom line. Could be good, could be bad, depending on how rates move.
And when you talk currency, you have to talk about exchange rate volatility analysis, how those fluctuations hit capital availability, hedging costs. We can use that FX stability score again to make the point, right?
Yeah.
A stable market like Canada might score really high, like 0.95, predictable for investors. But a volatile market, Nigeria maybe, could be way down at 0.4. Huge risk for investors and businesses there. That score tells you how predictable your international earnings or costs are likely to be.
And to figure out how much you lean on specific international markets, there's the market dependency ratio. Simple metric again. Percentage of your total revenue coming from one specific market. It helps you gauge your reliance on particular places. And more importantly, it flags opportunities for diversification. Spread the risk, basically, so if one market tanks, you're not sunk.
Okay, and to wrap up this analytical journey, we have the economic resilience score. What's this one telling us?
This score quantifies how well your business can actually weather tough economic times. It calculates the proportion of revenue or profit you manage to keep during a downturn compared to your total. It's a really critical metric. It encourages you to invest in resilient strategies. Things like diversified supply chains, strong cash reserves, flexible operations. All that stuff is absolutely vital for long-term survival and success in what's often a pretty unpredictable world.
So wrapping up this deep dive, it seems clear the economic environment is just fundamental to business success. It influences everything: consumer behavior, capital access, everything. By keeping an eye on these broad factors, these specific metrics we've discussed, you can actually anticipate changes, make much more informed, proactive decisions for your business.
Precisely. Yeah, it really hammers home the importance of strategic planning, solid risk management, and just being adaptive, ready to deal with economic volatility, global links, regulatory shifts, and those nonstop tech advancements. It's about being prepared, not just, reacting when things hit.
So given all these interconnected forces we've unpacked, here's something to think about. What is the single most critical economic metric you should be tracking right now in your specific environment to really ensure your long-term success?